These are the reporting dates. So most of the companies that I cover will report on the week starting the 17th of August. The key ones that week are Coles, Brambles, Invacare, Wesfarmers, and Orora. And then the final week, we've got Reliance, Woolies, and PWR. So I'll start with the key packaging stocks, Amcore and Orora. As I said before, I think Amcore is a potential beat candidate. It's performed really, really well over the last few months during the pandemic with 2 upgrades over the last 5 months or so. I think the momentum in the business remains strong. It's obviously a defensive business and has been recognised as an essential service in all the countries that it operates in. And so I wouldn't be surprised if the result once again came in ahead of market expectations. On Orora, I think there is some downside risk there. Post the sale of the fibre business a few months ago, beverages makes up about 2/3 of EBIT, while North America makes up the remaining third. On the beverages side, I think the outlook over the next 6 to 12 months or so looks subdued with various restrictions around the country. People aren't moving around as much, they're not going out as much, and that will have an impact on beverage consumption. Then in North America, Orora does have a big exposure to California, and unfortunately that state is currently under heavy restrictions at the moment. It also has exposures in the US to sectors such as entertainment, retail, and also convenience, and they've been hit also by the pandemic. In terms of valuation, Amcore is currently trading on 15.5 times FY21 PE with a 4.5% yield, while Orora is on 16.5 times with a 5.5% yield. Given where both stocks are trading and some of the risks going into the results, I just think Amcore is looking better value. I also think Amcore is a safer bet at the moment. I'll just be looking to switch from Orora into Amcore ahead of the results next month. Woolies and Coles, obviously the supermarket sector has been a key beneficiary of the pandemic. Woolies has provided guidance. They provided guidance in late June, so I don't expect too many surprises in the Woolies result. Coles hasn't given guidance, but I expect it to report a pretty good result as well. Key things to look out for, as usual, like-for-like sales growth, and they will be strong for both companies. The key swing factor, however, will be costs, with both Woolies and Coles having to incur extra costs around extra staff, cleaning and hygiene, personal protective equipment, security, etc. In terms of valuation, Woolies is now trading on 30.5 times FY21 PE with a 2.5% yield, while Coles is on 25 times with a 3.5% yield. Both stocks are definitely not cheap, especially Woolies. But in saying that, I also don't see a lot of downside risk in those companies while the pandemic is ongoing. I think people will remain reluctant to go out and hence continue to spend more time eating and drinking at home, which will be positive for Coles and Woolies. But in terms of preference, I do prefer Coles over Woolies, mainly on valuation. I think you're getting a pretty similar exposure there, but you're paying a lower multiple for Coles, and you're also getting a better yield as well. Wesfarmers, similar to Coles and Woolies, Wesfarmers has been a key beneficiary of the pandemic as people spend more time doing DIY around the house. Obviously, Bunnings has been strong. Officeworks has also been strong due to people working more from home. It hasn't been all good though. Target continues to underperform. Similar to the supermarkets, costs will be a key area of focus for Wesfarmers going into the result, with Wesfarmers also having to take on extra staff, security, cleaning and hygiene, etc. In terms of my view, the stock's on 27 times, 3% yield. I really like Wesfarmers. I think Rob Scott's done a really good job since taking over as managing director almost 3 years ago. But I do think the valuation is full. So I think it is a hold for now, but I think it is a great business and definitely one to put on the watch list if we do get a pullback in the share price. Where would I buy it? It is a long way off that at the moment, but I think if Wesfarmers were to drop back closer to that around that $40 mark, I think it would look a lot more interesting. Reliance, the result I think should be broadly in line. The last gave an update in May with the US going really well despite the ongoing spread of the virus. Australia was also performing well, but the key risk with Australia is the multi-residential construction market over the next 12 months, given this does represent around half of Australian revenue. The key unknown, however, as well is the UK, given that they have been under more severe lockdowns than in other regions. Revenue in the UK was down about 60 to 65% in April. It has recovered somewhat as the UK emerges from lockdown, but it is still looking pretty weak over there. On valuation, I've got Reliance on 17.5 times PE with a 2.5% yield. I still think it's a high quality business with really good long-term growth prospects with the ongoing penetration of push-to-connect fittings. The short-term outlook, however, in all regions is uncertain, but I think if you've got some stock, I think I'll be comfortable just holding on and riding it out. And the valuation at the moment, I think, is reasonable given the risks to the short-term outlook. But if the stock were to drop closer to around that $2.50 mark, I think it will look a lot more interesting. That would put Reliance on about 15 times, 3% yield. So I think that would actually be decent buying if it did get back to that $2.50 mark or so. Invacare, it's been a bit of a tricky one, this stock. When the pandemic started, to be honest, I thought it'd be a real positive for Invacare. But with social gathering restrictions and better personal hygiene, it's actually been the opposite. It's been a negative. The flu season this year, that looks like it's also going to be a fairly benign flu season. So that's another short-term headwind for the company. The key positive, however, is that the deaths that don't occur this year, they'll just be delayed into future years. There's obviously no escaping it. So similar to Reliance, I think the long-term growth prospects for Invacare remain solid. I've got the stock on 19.5 times PE with a 4% yield. If you look at the average of the Invacare's traded out over the last 15 years, it's been on around, it typically trades on about 22 times. And if you look at the average over the last 5 years with lower interest rates, the average has been about 25 times. So I think on about 19.5 times, I think still looks good value. The yield around that 4% mark, I think, is also reasonable. Acknowledge that there are some short-term risks, but I think Invacare is one of those stocks where you probably want to be buying when in a year where you've got revenue down, death volumes are down, obviously a benign flu season, and picking it up on 19, 20 times rather than buying it when death rates are high and revenue is really strong and potentially paying 28 to 30 times. So I think at the moment, I think where it is, you can chip away, but you just need to be a bit patient and have more of a medium to longer term view with Invacare. In other stocks, PWR, so that remains one of our key picks in the small cap space. The second half result, that will be impacted by the suspension of motorsport races globally, as well as the temporary shutdown of OEM factories. But motorsports has restarted again. So you will notice Formula One restarted a few weeks ago, and also OEM factories are also starting to reopen as well. So I think to FY21 could actually be a really big year for PWR. The stock's on about 23.5 times, so it's not cheap, but I think it's a really high quality business. We're forecasting EPS CAGR over the next 3 years of around 20%. The balance sheet's very strong. It's in a net cash position. So I think in that context, I think PWR still looks good value. And then on Acrow, I still really like Acrow. They provide formwork and scaffold equipment hire. The scaffold business, that's not very exciting. It's a low margin commoditized business, but Acrow are looking to reduce their exposure to that market. It's the formwork hire business that's a lot more interesting. That's linked to growing spend for infrastructure, such as road, bridges, metro stations, etc. and that'll be the key driver for Acrow over the next 3 to 5 years or so. The stock's on about 6.5 times PE, 6.5% yield. The market cap's only about 65 million, so acknowledge it is a micro cap. It's not for everybody, but I think it does look like a really interesting opportunity to me, especially if you want exposure to that growing spending infrastructure over the medium to longer term. So in summary, our key picks are Amcore, PWR, and Acrow. The other ones we like are Wesfarmers, Coles, Reliance, and InvoCare. Wesfarmers, I think it's a great business, but I prefer to pick it up around that $40 mark if it gets there. Coles, I do prefer it over Woolies due to valuation. It is a good, stable sector at the moment, while the pandemic is ongoing. Reliance, I think if it gets back to around that 250 mark, I think it would look decent buying. And then Invacare, acknowledge there are some short-term risks, but if you do have a longer-term view, I think it looks reasonable value around these levels. Woolies, Brambles, and GWA, I think they're genuine holds. And then finally on Orora and Pact, I just think Amcore's a safer bet at the moment in that packaging sector, so I recommend switching out of Orora or Pact into Amcore.